Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Phil Mackintosh, Chief Economist at Nasdaq, for an update on the latest COVID-19 news and how the markets are responding into the reopening of the economies. And Phil, it's quite incredible when you take a look at the performance that the stocks have put in the past 6 months, and of course, September 1st opening up on a high note as well.
Yeah, I mean, today the performance differential between the Nasdaq and the Dow is kind of symbolic of what's actually happened all year. We've really seen, even before coronavirus, but definitely since coronavirus, all of the new economy stocks getting a boost from the fact that we're working from home, that we're playing video games more, that we're using some of the Microsoft Teams software and Zoom, watching Netflix and buying products from Amazon. I mean, all those stocks benefited from work from home. And they've led the market. There's a lot of other companies that haven't recovered back to their all-time highs, though, and you can see that even in the Dow Jones performance, which is still not back to all-time highs, because it's got a lot of older economy stocks. Last week or this week, it's dropped Exxon and Pfizer. Like a year or so ago, it dropped AT&T, but it's got a lot more old economy stocks, and they haven't recovered quite as quickly as all of these new economy stocks.
And so we're also seeing it with the top 25 ETFs in August as well, the ones that had, the tech, the ESG, the work from home kind of stocks also ETFs outperformed.
That's exactly right. I mean, we were talking, I think, last month about the precious metals were just dominating our top 25 list, with everybody looking at the performance of gold and the performance of silver and the inflation fears and just general fear about the second wave of coronavirus sort of led to a huge amount of trading in the precious metal space. That's pretty much gone away for August. You can still see a little bit of silver in the list, but generally it's been replaced with a lot of tech ETFs, quite specific tech, some online retail, some video games, among other things as well. And some ESG is creeping into here, which is interesting. There's been a lot of environmental and social news, and it seems like some of those ETFs are actually picking up some assets as well. The other thing that I think you pick up from here is we talked a few months ago about the rush into value ETFs, and that's completely faded. But what you do see in the list again this month is more into growth. Growth and large cap ETFs have both seen some pretty good inflows across this spectrum as well. And the gap between growth and value, it looks like it's about 40% for the year. So it's really dispersed the performance of those two portfolio structures too.
And so I think what the issue is, or the disconnect may be, we understand the work from home trade, how long in the tooth is that? We're continuing to hit all-time highs, the velocity of the sell-off, the velocity of the recovery. It seems as if the market is ignoring the potential for a more classic recession, as you point out. We're seeing layoffs, we're seeing evictions coming. So it's hard to understand that disconnect between market performance versus what's actually happening.
Yeah, I mean, obviously the market's looking forward, and it's quite good at looking forward, maybe 12 or 24 months when we might have a vaccine, we might have a huge amount of money supply in the system. We may even get inflation, especially after last week's news that the Fed is much more open-minded about letting inflation start to get hold before it tackles interest rates. So I think the market is betting on the vaccine being pretty successful and everything else spurring the economy and spurring stocks, especially, who are able to reprice their products for inflation. But you're right, it seems like on balance, the risk is to the downside. There is potential for a more classic recession the longer that we live through what we've got. There's a little bit of a potential that the government doesn't come through with this next round of stimulus, and that would impact savings. It would impact potentially people's ability to pay rent. If we do see evictions, then we might have problems with property managers and landlords and credit risk. And that's a little bit more like an old-fashioned recession that takes a lot more time and energy to get through than just having a stimulus for a few months and everything magically coming back to normal. So I think there's downside risk in this market for sure.
All right, Phil, thanks for joining us on Trade Talks.
You're welcome, Jill.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.